Good afternoon and welcome to STANLIB webinar this afternoon. We appreciate you taking the time to join us. My name is Dave Watson. I'm one of the investment specialists with STANLIB. Today I'm going to be chatting with Sylvester Kobo, who is the deputy head of our fixed income franchise. And we're going to be chatting to you today and having a conversation around the STANLIB Flexible Income Fund. Before we get into the nuts and bolts and the really exciting stuff, just a couple of the formalities for today. If you would like to be eligible for CPD points, please stay on the call for the entire duration of the session. And the second one is we do have a Q&A functionality, and we'd really appreciate any engagement, the question that you as the audience have. We obviously want to make this as useful as possible for you, so please use that feature, and we'll leave some time at the end for answering your questions. Sly, welcome. It's good to chat to you today. How are you doing?
Yeah, man. Good. How are you, Dave?
Yeah, good.
Exciting times, eh?
Yeah, indeed. Yeah. I think this webinar comes at a pretty good time, given that yourself and the broader team have come out of our quarterly tactical asset allocation meetings. That's something that as STANLIB we pride ourselves on. It's once a quarter the various franchises within the business get together to have robust debates, share views, criticize constructively the views of other teams, and I think that really brings a robustness to the decision making across all the franchises within STANLIB. So very interested to hear what the fixed income team took away from that, and that was just 2 days ago. And certainly I hope what we're going to hear is maybe that slightly delayed party that was supposedly going to happen in bonds is now upon us. When you look at the fact that the Albi's done 5% just in the month of June so far, it certainly sounds like it could be the start of a party. So I think with that in mind, maybe we jump straight into some of your current market views before we get to positioning of the fund, etc. I think it'll set the scene well. Locally, obviously, top of mind for I think most of the people on the call will be the fact that we are coming off the back of a recent election. We're starting to see the dust settle there, and certainly there's indications that the GNU could be quite a positive outcome. Obviously, still in discussions, but could be positive for SA, potentially. Good for asset prices locally. So it'd be great to hear maybe some of your thoughts around that.
Yeah. Thanks, Dave. I won't be able to shake off this party in bonds clearly anytime soon. But it's exciting times and a lot of nervousness at the same time with this political change. So, with that in mind, going into TAA on Tuesday, we expected it to be very robust, like you said. So the debates were lively and robust. Up front, maybe let me just state that it's been a while that I, experienced the whole platform being so bullish on many asset classes, South Africa specific asset classes. So it was good to see, South Africa needs this. Hopefully this political shifts does result in a functional government and which delivers. So to touch on your question around the government of national unity, what it means for asset prices, and maybe some of the price action we've seen in bonds in particular, let me use an analogy that you will appreciate, I think, Dave. So think of it as an arranged marriage between a middle-aged man and woman, right? So their families are concerned, they're getting old, so they try to get them to go into a marriage. And they need to start a family anytime soon. So the negotiations go on. Eventually, they agree to go into this marriage. It's a big party, right? Champagne is flowing, aunties are ululating. Everyone loves this because these guys finally will get married, which is the market reaction you see so on screen there, that 110 basis points rally in bonds. So great. They've agreed. The party goes on. They go and sign the marriage contract, but they go back to their own apartments. What does that mean? Because obviously, if you want these guys to start a family, they need to move in together, which is where we are now with, this whole cabinet announcement hanging up in the air. There's a lot of nervousness in the market. Some of these gains that we've been seeing are now disappearing. So as a fixed income team going into this TAA, what we were putting forward was, hold on. Obviously, it is nervous times, But we don't think any of these guys would want to pull out of this arrangement, because it will just prove that they actually enter into this for their own self-interest and not for the benefit of the entire community or country in this case. So we think by the end of this weekend, they will move in together. A cabinet that is acceptable to everyone will be announced, and the party will start again, right? There will be another party, a leg up in markets, everyone ululating again. You know, this thing is happening. And by that, I mean, so if you think month to date, we've rallied about 100 basis points in bonds. And if you just look on that graph, this basically takes us to where we started the year, just unwinding the premium of that came with Lady R and load shedding of last year. But we're not out of the woods yet, right? The whole idea of an arranged marriage wasn't for them to move in. One would hope at some point these guys will have an adult conversation that will lead to the bedroom where the magic happens and kids pop up, right? Because, you know, parents are getting old, they want to see little grandkids. And by kids, I mean growth. I mean employment, you know, job creation, better lives for all, service delivery, you name it. Because when that happens over time, companies will regain confidence. They will start investing in the economy, which will create more jobs, more growth, which will then also lead to even offshore investors gaining confidence in South Africa and investing, so FDI, foreign direct investment, flowing into the country. And that's the structural shift that we are trying to put forward at the TAA, that you get this GNU or this arranged marriage to work over time. You can get that structural shift in SA asset classes, which will be positive across the board. And we're fairly constructive that we will get there. But it's not going to be pretty. Right? These negotiations, like I said, a middle-aged couple, they have their own views about life or whatever. And there will be a lot of posturing, a lot of negotiations. Like we're seeing now, it's not falling apart. It's political posturing, negotiations. You start in the outer end, and then you'll find yourself somewhere in the middle, which is when the country will benefit, because it's a negotiated outcome, right? Different views that cater for the population at large, that over time will benefit us. Accountability will be there in government. All these reforms that we've been seeing up to now will continue. And yeah, that's when, you know, even the rand will strengthen, and I guess interest rates will move lower. So just on the graph, what I'm showing here is, this is the CDS spread of South Africa, Mexico, Turkey, and Brazil. Turkey and South Africa and Brazil in the orange and the blue are similar rated counters. And you can see, I mean, around May last year, when the Lady R saga started and load shedding was at its worst, South Africa decoupled from Brazil. Whereas the CDS is essentially the cost of ensuring the government against the default. So our cost moved up, whereas a similar rated country moved lower. Even in the tail end there, where we've come down a bit, there's still a lot to go for that to compense to in line with similar rated peers. So as the baby making process continues, you can expect that to converge even further, which will, you know, give bonds and other asset classes a nice tailwind.
Yes, I think that's probably as exciting as you can make bonds, is comparing it to an arranged marriage. But I like it. I see
Yeah.
what you've done there.
Yeah.
I mean, with that in mind, and what you sort of alluded to it in these initial slides, that you expect rate cuts to come through. But I think it's an important point to unpack a little bit more, and especially on the local side, where there's, I guess, conflicting commentary in terms of, you know, some commentary saying, well, the SARB has got an intention to target the middle to lower end of the inflation band, which might speak to more restrictive rates looking ahead. But on the flip side, you've got commentary saying, well, actually, at the growth rates we have locally at the moment, we can't maintain such restrictive rates where they are at the moment. So two very conflicting commentaries. Would be good to hear in a bit more detail where you guys are thinking about rate expectations.
Cool. So, I mean, with the rand strengthening this month and, you know, positivity, I guess, confidence shooting up, in the markets. We've seen markets now starting to price in interest rate cuts this year. So now the market is calling for 45 basis, essentially 2 interest rate cuts by the end of the year, which is in line with our long-held view that probably the SARB will cut twice this year. Where we differ with the market is, the tail end or by the end of next year, we think in total they'll do 125 basis points, whereas the market is only expecting 73 basis points. And really our argument is premised on this. This is headline inflation forecast from our economics team. So where Kevin showing from where we are now, right at the end, the orange part, inflation will by the end of the year, he's expecting it to move lower, closer to 4%. Even next year, as it starts coming off and moving higher, it goes to around that 4.5 level, which shows that really South Africa's inflation is contained. There's no need for interest rates to be at this restrictive level. So on this next chart, essentially the neutral rate is the rate that the SARB says it's neither restricting the economy or firing it up. It's a neutral rate. Whereas their current policy stance, we are well into restrictive stage. And given we know the amount of pressures that the consumers are facing currently, even the Q1 GDP numbers were negative. So there's really a lot of pressure on the economy. It's struggling to gain momentum. So which is why we are comfortable that even before the Fed moves or the Fed cut interest rates, these guys need to take their rate stance to at least neutral. So, but you can argue if growth is already negative, unemployment is high, the consumer is struggling, they actually shouldn't even be at negative. They should be, at neutral. They should be in the more accommodative territory. But given that, like you mentioned earlier, they want to target a lower band, or rather point target of maybe 3.5% over time. They probably don't take it too much into the accommodative territory, at least now, but we're comfortable that they will take it to neutral at least. So, and if you now fast forward to next year when inflation is at 4.5 plus that 2.7% basically takes you to 7-year rates, which is why we're comfortable with our forecast of 125 basis points in total, given that we are at 825 now. So, and now if you bring in the global aspects, the Fed or the major central banks, on this chart, well, first, we know inflation globally has come off materially. And we've seen earlier in the month with the European Central Bank, Bank of Canada cutting interest rates. The UK's inflation is now at 2%, so we expect them to go again in Q3, and then the Fed will follow. And once that happens, right, we think that will trigger or revive the carry trade, because as we know, liquidity follows the path of least resistance. And that's that path that I'm pointing on screen, which is the emerging market real yields, so the 10-year bond yield less inflation. Maybe to paint the picture differently, US real yield is at around 1. So you have 10-year bond that's 4.3 and inflation over 3%. So it's not attractive compared to EM. And we think as the major central banks cut interest rates, you're going to get a lot of flows chasing yields. And South Africa, as you can see, even with this rally that we've seen this month, is really standing out there. The only other one that present from a valuation point of view a good story is Brazil, but as you know, they've cut interest rates, and actually their market is now starting to price in 6 interest rate hikes from here on, whereas we are about to start our cutting cycle, which will, I guess, make us more attractive compared to them.
Yeah, and so maybe just on the point you've made there, I mean, a popular question that comes up, especially when there's commentary that, the SARB may cut ahead of the Fed, the natural question is the currency then put at risk? Like, do we see risk around that? It'd be good to hear. I mean, I won't hold you to a number, what do you think on the currency, but it's just directionally interesting to hear if, do you think that would be an implication if the SARB cut ahead of the Fed? But I suppose maybe medium term it's buffered by the fact that you said when they start to cut, all of a sudden emerging market, the real yield is attractive enough to support the currency again.
So here's an interesting fact. I was reading a research article about 2 days ago. that showed that year to date, the rand is the only emerging market currency that's up against the dollar, right? And most of that has been because of this shift, or the market getting excited around a potential structural shift for SA, which will be supportive of SA asset classes. So and that happened at the same time that the market was moving from expecting no cuts until the end of next year to cuts this year, whereas the cuts for the US were, touch and go. So there's a lot going on. I mean, the rand has shifted materially from trading sub 15 to 18, 19 now, where it's oscillating. So, and a lot of that is South Africa specific or idiosyncratic risks. And what I was saying earlier, or alluding to, if this GNU becomes functional and some of these risks unwind over time, regardless of the policy stance, that risk has to unwind. So the Fed or the SAP need not wait or need not worry too much about the yield differential or interest rate differential to the Fed, because our currency is already pricing in a lot of the negatives that have built essentially from when we got downgraded and then grey listed and then load shedding and so forth. Remember as well, something that we get fixated now on what's going to happen to rates globally, but we forget the gains that South Africa have made to point. I mean, we're well into winter. There's no sign of load shedding, right? Some of the reforms that this operational Vulindlela has delivered, you can see the result of it. It's actually happening now. The only thing that was, and also on the fiscal side, we've achieved primary budget surpluses for the first time. And we've actually done even better than the February, from a main deficit point of view, the February budget. Those things are in the back burner now because we just focus on global rates and we focus on elections or the political outcomes. Once this settle, this will be staring us in the face. And that will be positive for the rand. I'm not about to commit career suicide and thumbsuck fair value for the rand or where it will go, but I am saying from where we are, it's stronger. It looks, if politics settle, it will be materially stronger than now.
Okay. I mean, Slav, we could talk local all day. I mean, there's always something to talk about here, but I think importantly, again, in this flexible income mandate, you've got the ability to bring in a component of offshore as well as a additional alpha driver, diversification tool within the portfolio. So just if we flip to the offshore side briefly, and the US obviously has their election coming up later this year, and there's uncertainty around what that could do for markets. But if you look at US bonds at the moment as an opportunity, what are you guys thinking about that?
So bond returns, or if you're trying to figure out where bonds will go, essentially, simplistically, you need to figure out what will happen to interest rates. So interest rate expectation plus a term premium. As an investor, you demand to be paid a premium for investing in a 1 year, or a higher premium for a 10-year bond than a 1 year bond, essentially. That determines your bond returns. Now, we all agree that the market generally, consensus is the Fed will start cutting rates this year. So that part will benefit US bonds. Yields will move lower, which will be positive which will prices will move up. But what I'm showing on screen here is a really scary picture of the fiscal trajectory of the US. These are numbers that were released late last week by the Congressional Budget Office. And they're basically saying debt to GDP in the US will move from around 100% now to over 160% in 30 years. And the scary part about this is that in their assumptions, they don't assume there will be material downshifts or material downturns like we had in the global financial crisis and COVID. And they're also not assuming, or they're also assuming that Trump's tax cuts from 2017, they are due to mature next year or to expire next year. They are assuming that those won't be rolled over. Now, you mentioned the election, US election in November. If Trump wins, the market will now have to start at this picture and say, is this sustainable? Surely the US curve cannot stay as inverted as it is now, where the 2-year bonds or T-bills are yielding higher than the 10-year bonds or 30-year bonds. So there has to be an element of term premium in that market. So which is why we're saying US bonds, longer dated bonds, with this picture, unless these guys have an adult conversation around resolving this fiscal mess, the long end bonds will probably stay at this 4% level for longer. So the benefit of interest rates coming down will be eroded by term premium moving higher over time. And the reason we're saying that, I mean, the counter argument is, yeah, but the US is a reserve country, reserve currency, so people will always buy the US. What we're showing on this graph is the top purple line there, pre-2008 or pre-global financial crisis, the majority of holders of US treasuries were public institutions, foreign central banks, which really don't care about price much. They buy to hold these things for reserve. But you can see how that line has tapered off over time. Now households, so households, Dave, is your pension funds, unit trusts, those kind of guys have been taking up most of the issuance, the supply of US treasuries. And those guys are price sensitive. They care about the price or the return they get on these bonds. So if indeed supply is going to ramp up as the CBO projects, the price has to be higher, which is why we're saying probably, neutral rates or term premium in the US over time will need to spike higher. The yield curve will normalize again, and probably you get a lot of value by staying in the shorter end of that curve. So 5 years and below, because that will benefit from interest rate cuts, but longer dated US bonds. And as in SA, we've seen it, right? From the time we got downgraded, getting kicked out of the week B with flows leaving. We're not saying it's a credit risk story in the US, but we're saying there will be a higher price that's demanded for taking duration risk in that market, and that will mean probably US Treasury stays at these elevated levels for long. So we won't be going gung-ho in that space, especially the longer end of the curve for this fund.
Yeah, that's very insightful, Sly. I mean, I think what you've told us now, it gives us a good sense for views across markets and geographies and some of the asset classes that are available to you within STANLIB Flexible Income Fund. And I guess it also highlights the importance of having a team that has a mandate that is flexible, that can digest this kind of information as it comes to market and reflect that in positioning for clients.
Yeah.
Because as we've seen, I mean, even with the slide that's currently up, I mean, telling a very different story than what you might read in headlines about it being a reserve currency, etc. So yeah, I mean, Sly, with that, if we start bringing it back to the actual mandate, you start talking a little bit about STANLIB Flexible Income Fund itself. Potentially, you can just initially position, where does this fund sit within our offering, and what are some of the high-level benefits that clients can experience from a multi-asset income type of mandate?
Okay, so if you look at the bond yield curve or efficient frontier, at the short end you have money market funds, income funds, and then bond funds right at the end. This fund sits right in the middle because it can actually go into all these other different asset classes. So it's a multi-asset income fund with, it gives us that asset allocation ability and, like our title says, agility to move in and out of the different asset classes according to where we see value on behalf of the client. So, I mean, this nervousness, excitement, uncertainty I was talking about earlier, clients wouldn't, the guy on the street wouldn't know when it's best to switch out of money market and go higher up the curve to benefit from interest rates moving down. And as managers, it gives us that ability, right? And why that is important, right? So if you look at over the last, so this is 6 years, right? How the different assets, or 5 years, how the different, maybe how bonds and cash has performed. The red line being cash, you can see over time, even through obviously cash is a very defensive asset classes through many crises or many crises. It's given you a smooth and steady returns, but bonds have done better than that, although with a lot of volatility. Now, and as a fund like this, where it comes in handy is that it gives you as a manager, the ability to actively shift your asset allocation across different asset classes. We mentioned offshore earlier. You can also pull or put in allocate to property here to make sure you get a smooth return profile. And as you can see right at the tail end of this, actually across the board, this fund has been able to give you bond-like returns, but with way less volatility that you would experience in bond funds. And that's the beauty of it, a fund like this, especially in an uncertain environment.
Yeah, and I mean, I guess you could say this fund is maybe the opposite of an arranged marriage. You can move around as much as you like.
Single. Being single.
But I'm going to put you under a little bit of pressure and say, I mean, obviously this paints a really good picture for these kind of mandates, and you've obviously referenced our fund specifically, but you know, the ASISA multi-asset income category is one of the most competitive, particularly in the last couple of years, in terms of the number of funds competing in that space and the appetite for those types of funds. So, I mean, with that in mind, why specifically STANLIB Flexible Income, and why do you think our fund warrants consideration by clients who are on the call with us today?
So, if I'm a client looking at who should I choose as my manager in this space, like you say, there's so many funds here. You really want someone that will be agile, that will use the full allocation or flexibility that this mandate allows to capture, to maybe be defensive when they need to be on behalf of the clients, and if there is upside that should be taken, they're able to capture that as well. And you know, as the STANLIB Fixed Income team, we've shown through many different markets, and I guess that's the blue line at the top there, that we are able to fully utilize the flexibility that this mandate has offers for us. I mean, and it's not just at an asset class level, right? So if you look at this next chart here, showing our major competitors, how they approach the duration management, you can see most of these guys, I mean, they pick a desired duration position through the 5 years where we show in this chart. All of them have stuck generally to that duration view. And if you just take the month of June, May, June, where you started off, we were going into an election, the market sold off, election results were palatable for the markets, we've seen a 100 basis points rally. So if your duration was static throughout that period, really you've lost out on opportunities to capture value on behalf of our clients, compared to how we actively manage duration in this space, showing that we've had points where our duration was as high as 5 years in the portfolio, and if we're really negative, we've taken it down to 0.5 years to really capture the value across the different markets on behalf of the clients. And that is who I would want managing my portfolio, to ensure that my return outcome is smooth, and over time they create value for me. So this is not a portfolio, we think, or this space is not the space where you choose someone who will say, no, I'm going to stick to a 5-year structural view, and eventually markets will return to their fundamental values. There's a lot of noise, there's a lot of froth in between where there's spikes in the markets, and you want your manager to really take their time and stay close to the markets and exploit those opportunity sets. And I mean, at STANLIB, fixed income team has been doing this for many years. I mean, it is the most stable fixed income team in the country, the largest even by size, right? 280 billion rands assets under management. We've grown 100 billion rands over the last 10 years. And we are really not shy to throw around that weight on behalf of our clients when we're negotiating deals. And that's the kind of guy you want to at them making investment decisions in a mandate like this. And also, more importantly, we're dealing with so many asset classes in these funds, multi-assets. So the more you have diverse thinking, diverse team that thinks differently, that have robust debates, the more we feel that results in an optimal investment decision for clients, which we have shown over the years. And our team is very diverse. We don't have a team slide here, but majority are women and doing real work. I mean, I would go to war with this team. We really, really take what we do seriously. on behalf of our clients. We take our duties very seriously. We don't sleep on behalf of our clients.
Yeah, it is. I mean, this slide really speaks to it. Obviously, only just looking at duration, but you can see how actively you guys are utilizing the flexibility allowed to you in this fund.
Yeah.
Before we get sort of further into our fund, we did just skip past one slide. If you could go back quickly, I think it's an important one, just in terms of again, broadly speaking to this category of funds.
Yeah.
And I think it's obviously a popular fund. It can be used both pre and post retirement, but post retirement, obviously, when it comes to income funds, very popular. And what we've really shown here is that looking at 3 ASISA categories, from money market to income funds to these multi-asset income funds, and essentially said if a client invested R1 million in one of these categories, and we've used the averages, a 3-year average here, we sort of said how many years of income is that client able to buy? And what you can see there, by moving just from income to multi-asset income, you've actually achieved a number of years more income for your clients. And you can see there the multi-asset income category average was about 7.4% over the last 3 years. The STANLIB Flexible Income's done in excess of 1% better than that, which means you'd probably see that line even further to the right. So it's really important, I think, especially, you've alluded to the fact rate cuts may be coming, etc. Potentially a prudent time to think about maybe just stepping up from an income fund to a multi-asset income fund so clients can capitalize better on a rate cutting cycle. So I think just important to paint the picture in terms
cash,
of...
right?
Yeah.
I mean, the saying cash is king, but as the ancient Romans say, what's the proletariat, so the law of the working class. So in an environment like now, the worst place you want to be is in cash. As, this structural shift potentially will lift every other asset class except for cash, especially with rates coming down. So if you were a client looking to say, how can I better, capture more value, you probably want to move up the curve from cash. Yeah,
and absolutely. I mean, as soon as you hear about those rate cuts, the first place you feel it is the bank account. The next day, those rates are reflected.
Exactly.
So we can skip past the one we've obviously chatted about in terms of duration, but we've chatted a lot about flexibility and using that flexibility in the mandate. We've seen in points in time and currently where this fund will have 0% allocation to certain asset classes based on your views at any given point. Maybe just some of your views at the moment and how that is being expressed and using the flexibility. You can just show us current positioning.
Okay. So where we are now, this is how we've positioned the portfolio as at yesterday, actually. So if I'm saying, or you were saying it, the party in bonds will continue. And it comes up in our positioning, right, where we heavily overweight bonds as a sector, so both nominal bonds and credit, but more, tilting towards fixed rate bonds, because you expect interest rates to come down. I said we don't like cash, 2.5% allocation, and interestingly, currency allocation to dollars being 0 now. Right? We've, if you look at March and May, we've had some dollars in the fund to protect against the possible whiplash or fallout from elections. Now that we passed that, we've taken that out, but. Importantly, you can see in May, going into elections, we had cut from quarter end to May. We had reduced both nominal bonds, credit, and we're hiding in cash. And now that we think, it's looking, the picture is looking better or rosier, we've now gone back into the better return prospect asset classes. And property, we've gone back. We had taken it off, not because we were worried about election, but it had done well for us from November last year to the end of March. And then we thought, let's take some money off the table. But obviously in an environment, a positive or shift that we're expecting will probably lift growth assets. So we've gone back into that asset class. Inflation is not a problem. We don't like inflation-linked bonds, and we've been expressing that, I think, for most of this year.
Yeah, it's quite remarkable to look at the slide, and just in the span of sort of 3-4 months, how dramatically you've shifted in and out of different asset classes and moved the fund around on the back of news that comes to market and how prices reflect that. And I think, again, if you take that and you consider the previous slide in terms of actively managing that duration, it just speaks to, if you do take that static view, you're potentially leaving quite a bit on the table in terms of returns that can be harvested for clients on it by taking tactical views.
100%, yeah.
And just to ask you a couple of questions on this, you look at the bonds exposure, obviously particularly high at the moment. Bonds is obviously quite a broad statement. I think maybe just in terms of which bonds are you guys buying? Because, you know, is it 5-year bonds, is it 30-year bonds? There's quite a range, and they carry their own benefits and risks.
So this is still an income fund. We're very cognizant, we are alive to the risk profile of an investor in this portfolio, so we wouldn't buy longer dated bonds in this portfolio. We buy typically your 5-year bonds. We can go as high as 7 years. That mainly talks to views or around mostly rates, because that plays in there. But the more you go out on the curve, fiscal risks come into play, and so forth and so forth, and the volatility is quite high. So we steer clear of that. We prefer the shorter end of the curve. So if you think the all bond index buckets, the 3 to 7 year bucket is where we play.
Okay.
For this portfolio.
Yeah, I think it's just good to highlight that.
Yeah.
And the other one, just to pick on another, is obviously credit, which is another large component within the fund. It's an asset class that's been in the spotlight recently. There's obviously often questions around liquidity in that space. So I think, again, just to maybe talk to you how you guys manage that dynamic within the portfolio. How do you manage liquidity in the credit space within this portfolio?
So, I mean, credit in SA is quite illiquid. It's a tricky asset class to manage actively, which is why in this portfolio we wouldn't buy direct whole company holdings. So we wouldn't buy, say, an MTN or Transnet bond directly. We'd rather allocate to our bigger income fund. So that's a 58 billion rand portfolio that's very diversified. So to make sure that when we want to shift around, like you said, from 32 to 29 to 21 within days, we are able to do that. It's a T+1 investment decision. So, you know, the buy and sell philosophy holds for this portfolio. So that's our approach to credit in this portfolio. I mean, and credit as an asset class itself, even globally, things can go wrong there. Sometimes they do go wrong, which is why we have a robust credit process. So our credit team headed up by Terence Sankar looks at every credit we invest in at STANLIB, but above that, there is a credit committee that also vets all the decisions that this credit team puts forward. So I won't just wake up and say, call up Vic and say, wow, let's invest in MTN. If there's no limit, there's no limit. And there is no way I can, you know, change their decision if they've done some fundamental work and have taken a view on that name. So a robust credit process is key in SA, which has ensured, I mean, you said there's been a lot of the stuff with the taxes beginning of the year. We've never had that even in the main income fund because of the robust credit process and being at all time cognizant of the kind of clients that are investing in this portfolio. Obviously, if you're in a illiquid credit mandate, those kind of counters make sense there, but not in these two portfolios. And that's our approach to credit.
Yeah, and I think another thing to add there, and not specifically just on credit, but again, talking to that, the benefit of those tactical asset allocation meetings with the other franchises, you guys can get insight from other teams that are maybe looking at a similar issue from a different perspective. Yeah. And sometimes that just helps, I guess, cover the natural blind spots that anyone might have.
Actually, not just at the tactical asset allocation meetings. We have different independent guys from other teams coming into the credit committee meetings. Say we'll have an equity guy there. If it's a property counter that we're looking at it from a credit point of view, you'll also get a property specialist view taken into account. So we look at it holistically to make, I guess, the right call for our clients.
Yeah, important. So I guess it all sounds great. We've briefly touched on how the fund's done here and there, but I think ultimately the question always is, does it say what it does does it do what it says on the tin, and has the fund delivered the outcomes that are expected by clients in this fund? So maybe just talk us through how the fund's performed as well.
Okay, so if you invested $1 million 5 years ago, today, if you were invested in this portfolio, it would have been 1.52 million rand. Compared to, say, its benchmark, so 110% of STEFI, that's, you know, call it 1.4 million rand. So consistently outperforming the benchmark. But even better, compared to inflation, I mean, inflation would have made that million rands 1.27 million rand. That is what we call delivering to the promise that we make to our clients. Headline numbers, I mean, 1 year to the end of May, 11%. inflation 5.2%. The target or the objective here is CPI plus 3, inflation plus 3, comfortably outperforming that across all the measurement periods. So the fund is doing what it's supposed to do and better. And these numbers, by the way, are not talking to the rally that we've seen in June. So probably the June numbers are going to be astronomical from here. Benchmark, it's 110% of STEFI, also from returns versus benchmark. We target there 1 to 2% outperformance, and you can see how this fund is doing well across the period.
Mm. When I looked at the slide earlier, I had to just double check that I wasn't going to be sitting in the room with one of the equity guys. No, really like very good outcomes, from you and the team.
In a challenging environment.
Absolutely, exactly. You see on this slide as well, and you mentioned it, the fact that this fund does have a STEFI-linked benchmark. Maybe just unpack that a little bit in terms of why we've got a cash-linked benchmark in a fund that can take on a little bit of risk as well.
So that talks to our risk management or our approach to risk in this portfolio. Remember I said it's an income fund. Generally, the investor profiles in this kind of funds are risk-averse. So, and that talks to why we chose a cash benchmark, because we don't want to have maybe 30% in bonds, 30% in property, and 30% in cash. And if bonds do minus 10% and this portfolio has done minus 2%, we say, yes, we've done our work because we've outperformed the benchmark. So risk for us in this portfolio is absolute loss of cash, so negative returns. So that cash benchmark holds us accountable or makes sure that we avoid losing cash on behalf of clients as much as possible. So obviously we don't have the time that normally happens in a DD process around some of the risk metrics we look at in this portfolios, because a lot of things can go wrong in these mandates, right? We investing in sometimes racy asset classes, so we really need to make sure that we have a robust risk management process to make sure over time consistently we deliver to a client's promise.
Yeah, and absolutely. If it is an income fund, you've got the returns you achieve are one thing, but at what level of risk is equally important.
Risk-adjusted returns.
I think it's important as well that the fund does still have that overlay of a CPI plus 3 target, because I think it's important to have those absolute returns in mind as well, because that's ultimately what a client needs.
Yeah, exactly.
There's that classic saying which says relative performance doesn't pay school fees. It's got to be, you've got to give good absolute returns for clients. So we've talked about quite a lot, and I'm mindful we want to leave some time for audience questions. So maybe just, to wrap up before we get to that, and maybe for any people who are logged in that maybe we're doing some emails on the side, just 3 key takeaways that you think should be taken away from the webinar today.
So first one is the arranged marriage is in place. The couple will move in together, babies will get made over time, and this will provide a structural shift for SA asset classes. If you're sitting in cash, I would be sleepless at this point in time. There'll obviously be a lot of noise, but we think all parties involved really want to see a great outcome for the country, and we're constructive on that. And also, I guess the second point is, like you said, the multi-asset income fund space has a lot of, it is probably one of the best for risk-averse clients, solutions for them to consider moving out of cash and traditional income funds into to capture some of that capital return benefit, but also more importantly, the type of manager that looks after your fund in this space really has to be agile. They have to be flexible, they have to be active, utilize all levers available to them so that they can capture that value for you over time.
Yeah, I think that's a pretty good summary. Thanks, Lai. I'm going to just jump across here to a couple of the questions from the audience. Okay. Let me just check here. So we've got a question here coming through, and I think quite a good one, saying, is it too late to join the party? I like the choice of words there, party again. As interest rates drop, bond prices rise, in layman's terms, can someone enter the income fund before the rates drop and enjoy the party, or has the party already been priced in?
No, I mean, what I showed earlier was our expectation for interest rates is lower than the market is pricing in now, and that's just to neutral. We're not talking about a really positive outcome from elections that might over time lead to structurally lower interest rate environment. I mean, we mustn't forget that it wasn't, or actually as early as 2-3 years ago, 10-year bond yields were at 9%, trading around 9%. And pre-COVID, there were points where we were trading at 7-8%. Actually, even when I joined the team, at some point, 10-year bond yields were 6.5%. Now, if you're talking structural shift over time, where some of these growth impediments get removed and the country incrementally moves in the right direction, the market will move quickly to price that in. And that's not the time to be joining the party. You know, you really want to be there when, you know, the good booze is still out. So you can also set yourself up, get the mood right.
Yeah.
Yeah.
I mean, and if you think back to your first slide on this presentation, I mean, when you look, it feels like there's been a material rally, and it has, but it feels like, could the party be over? But you look over that longer period and you can see, like you say, it really just took us back to where yields were beginning of the year.
Yeah.
There's still quite a lot of room for those yields to come down and for clients to participate in that rally.
Exactly.
Yeah. Another good question here from Mark. Earlier this week, it was announced that Eskom would seek a 36% increase. How would this impact your inflation outlook?
So obviously higher, but I mean there are other forces that are working. I mean, food inflation has been more behaved than both the sub and market participants have been expecting. So some of that will negate, you know, that's 36% if they get it approved over time. But even if, say, we move sideways from here, we're not talking SA inflation going back to 7-8% like before, right? Maybe gets closer to the 5%, but still, you're still in restrictive territory, and you need to maybe ease up on rates a bit if you are the sub.
Yeah. So I guess also maybe there's always risks out there. I mean, obviously you can see from positioning, you can see from the way that you've chatted today that there's a level of optimism in terms of how the fund is positioned at the moment, but there's always risks. So it'd be good maybe just to touch on the couple that are top of mind for you at the moment.
So locally, sticking with the GNU, right? Remember these guys, they're still talking about this. It's about positions now, right? They still need to make the government work. And now that it's a multi-party system, I mean, if you look at, say, maybe now, when the ANC was ruling on its own, there was an executive and there were party policies. Some of the party policies have, over time, been ignored because the executive or president and the cabinet have taken a different view to what the ANC people wanted, and they've been able to get away with that. But in a multi-party system where, and we've seen it with the leaks in the media, where the parties themselves are actually involved in formulating policy or negotiating these outcomes, it might be noisy, right? And it might mean maybe less powers on the cabinet. So what you want to see is quickly get to a point where you have, I know you're not that old, you don't look that old, post-1994 CODESA kind of talks where all these guys sit around the table and say, okay, fine, what do we stand for instead of, in terms of policy, and so many other things, foreign policy, all these things. These guys need to not talk bilaterally, but as a unit around the table and say, as a unit, what do we stand for? And that's a big risk. That will cause a lot of noise and can lead to even a breakup of this whole thing if they can't get together, because now political parties are actually involved in the cabinet decisions. So something we're watching very closely. Globally, it looks like we've hit bottoms on inflation, right? Geopolitics are not abating. Elections create their own risks. I mean, we know, we spoke about the US, but we've seen with what happened in India, Mexico, and so forth. And some of these, either leftist or right-leaning fragmentations across the world might also bring a lot of uncertainty to the system. So we must just get comfortable that volatility, uncertainty will be here to stay, and be ready to navigate it. It's not going to, we're not going back to pre-COVID times anytime soon. So there's still a lot of, and with these things like elections, geopolitics, these are stuff that are hard to forecast for market participants like ourselves, right? So, which is why we try to remain as nimble as possible and flexible to, react as and when needs to be, because really we cannot say if who will win in the US. Now you have the French elections. There's just so much going on that we think being nimble, being flexible will probably stand us in good state than someone who just chooses to sit and ride it and say over time it will get back to fundamentals.
No, absolutely. And you got to stay alive to those risks, especially the ones like you say that are, until they occur, you can't really guess the outcome.
Yeah.
And I mean, you've alluded to it. There's plenty of elections. I think it's 65 elections around the globe this year. So that's plenty, and some big important economies.
Yeah.
And like you say, I mean, the geopolitics certainly isn't slowing down. There's still a lot of uncertainty in terms of that as well.
Yeah.
Just another one here, and you did touch on it early on in the presentation, but just briefly, in terms of what is the scope for international investors to re-enter the SA bond market? I mean, we are, again, to your points that you made, the real yield is attractive. There are risks, but we think potentially rewarded for that. Do we think we could see appetite?
Well, from a valuation point of view, if you are an emerging market investor, we stand out, right? But I don't think they necessarily, with all these hang-ups across uncertainties around the world, necessarily rush back into SA until they see tangible actions towards actually resolving some of the issues the country is facing. So I think it will be incremental, and they will need proof points, right? So as this GNU gets functional and you get little wins, I'm not in the camp that you need to start getting ratings upgrades first before foreign flows come into the country. No, but if we start incrementally moving in that direction and the foreign investor gains confidence that we are indeed, there is a shift, then you'll probably get more, some of that foreign flows coming into the country, because from a valuation point of view, we really are sticking out.
So it could almost be like a secondary tailwind.
Yeah.
If we get some of this stuff right locally, then we could start seeing that as a secondary tailwind to those yields coming down.
100%, yeah.
I don't see any other questions coming through here. Just let me do one last check.
Okay.
Okay, there is one here, and it's just asking in terms of any expectation or idea in terms of yields you might expect from the portfolio in the course of the next year. I know with Flex, it's a little bit more difficult because there are some assets in there that are kind of a bit more capital in nature. The capital value can move around, but is there anything you would add there in terms of yield expectations for the year ahead and within the fund?
Yeah, so I mean, Flex Income Fund is not that kind of portfolio. Not only because but it invests in a vast array of asset classes, sometimes with which the yield is not observable. Yield is a play from pure bond point of view, but there's other stuff that you have to take into account, which we, like I said earlier, we went into property to try and benefit from growth assets point of view. So that's capital increase, not a yield play. So more yield play if you're investing on this. I mean, it might be very frustrating to an investor, given how active we are in the portfolio. I mean, if think about it this way, if you had come in as a client end of March, when we were heavily tilting toward bonds, and then just before elections, we've taken that out, we're sitting in cash, yields would have dropped. But there was something we are trying to do there, right? But in totality over time, the total returns stack up. And that's how you should approach this portfolio. But in terms of maybe where we think bond yields are heading, I mean, our fair value, the fair value that we're pushing forward in this in our TAA now was that bonds over the next 6 to 12 months, 10-year bonds will go to 1075 from just over 11.5 now. But that's not with the complete structural shift. We're saying we still need to see tangible proof points that indeed this politics will settle, and over time, we will probably shift it lower towards below 10 or to below 10%. So over time, with this political shift, most things hang on it. You can get SA bond yields moving lower, which from a capital accretion point of view will be beneficial.
Yeah, I mean, I don't think anyone on the call will disagree that we hope this arranged marriage will work out and bear fruit for everyone. I think, mindful of time and no other questions coming through, so I think I'll wrap up there. So thank you very much for the time. It's always great to chat with you, and really enjoyed it. And I hope the audience enjoyed it as well. Thank you very much for taking the time to listen to this today. And if you have got follow-up questions, please get in touch with us. You're welcome to reach out to any of us in the distribution team if you want to have a further discussion or discuss the fund in more detail. We're always available for that. And I think importantly, from an access point of view, we've worked quite hard to make sure this fund is available across most major platforms. But certainly if you ever run into challenges in terms of accessing the fund, please reach out to us and we can try do what we can to assist with that. Thank you very much everyone for the time, and have a good afternoon.